get the peg right, then the adjustment right at the end, when you've done the completion accounts and you're working out, is there a deficiency in working capital or is there too much surplus assets, liabilities? The adjustments should sort of offset each other if you've got the peg right. But getting the peg right, it depends on you knowing exactly what should be in working capital and having the accounts as clean as possible. Because when you're doing completion, they're going to be cleaned. The acquirer is going to mandate that you adhere to the appropriate accounting standards. They're going to question every item in them that could be conceived as being an adjustment. So they will. So they'll do that. So it's really good to be keeping the integrity of the accounts.
Yeah. So just again to I suppose dumb it down for my benefit more than anything. When we talk about the peg, we're talking about the appropriate amount of working capital that is needed to run the business.
Yeah. Yeah.
So anything over and above that either goes to the acquirer or is retained by the vendor. But basically, it's getting that number right. Okay, what do we actually need on a day-to-day basis to run this business?
Yeah, absolutely. Absolutely. Other things that will impact that are around leave entitlements, excess annual leave. That will be treated as an adjustment to debt. If you've got more than 4 weeks annual leave, it's considered excess as a bit of a rule of thumb in the industry. Long service leave can be treated as debt-like. Some of it can be treated as working capital. So it's one of those negotiation points. So yeah, it's making sure you're just aware of that.
Should we maybe we've got 10 minutes left,
Yeah.
Chris. Should we talk about some of those examples?
Yeah, absolutely. Absolutely. So we did a deal last year where we're on the buy side for a syndicate who was acquiring a contract manufacturing business, it says there. So it was a really good business. It was producing a lot of profit. The vendor, the main vendor, he was quite elderly. Set up a good business though, and you've got two of his key employees as shareholders as well. So they were all pushing together to get this business up, and it was doing great things. It was turning over heaps. Yeah, during the negotiation, they got offered a really good price. There was a bit of complexity in the way it was going to be structured in terms of paying that price. So there was cash consideration, vendor notes, and vendors were going to also invest in the business, the combined business. So one of the things that happened throughout the deal is that a lot of stuff came to light. There was an issue with one of their main clients leaving, which was known by the vendor, and they only told our clients towards the end. So that basically halved the price. Then there were other clients who were leaving as well. So there were provisions written into the contract that if X, Y, and Z client leaves, well, then the price is going to be reduced by X amount of their annual trading. So they had this really good sticker price, but because they hadn't locked revenue in, they kept getting all these hits, and they've continued to get those hits. Yeah, and I was mentioning about the working capital. So yeah, they didn't have reliable accounts. We only looked at 3 months, and every time we got a new month, because we were continuing to negotiate, every time we got a new month of results, it jumped up and down. So we had to keep extending it, and they ended up having to accept a higher figure than possibly what it should have been. So our client benefited from that. What else?
I think that's a really good point around maintaining the hygiene of your accounts. And we lost a lot of confidence in the fact that the accounts had not been prepared on a quality basis over the journey, and we just couldn't have confidence in them. One of the interesting ones, what were they turning over? About 30 mil.
Yeah, 36.
And their accountants had continued to treat them as a small business entity for things like instant asset write-off, which I think the turnover at the time was about 2 mil.
Well, they were they were reporting their income tax return and BASs on a cash basis.
Yeah. In light of that, in treating them as a small business entity, that old rule where you can use cash accounting, for stuff like this, it just diminished our confidence and led us to want to chip the price.
It killed credibility.
Yeah.
We couldn't trust what they would say, so we had to do more and more work. And it's, yeah, our client's done well from it, but it's cost the vendor a lot. And just, yeah, I don't think the corporate advisors who are looking after them did a particularly good job because of the extent of price chips. And we're in the warranties and indemnities phase at the moment, and things keep coming up. So I think it was just today or yesterday, we got notification that the SRO is coming in to audit them. So that's going to one of the indemnities, one of the tax indemnities. Basically, if anything is found from that audit, any amounts that need to be paid, it's coming off what the vendor's already received as consideration.
So I think that's a great takeaway for the advisors in the room, is that when preparing for a transaction, that due diligence period is really going to be for the acquirers to really dive into the business to try and form their warranties and indemnities. So that's what the due diligence process is around, so that they can then safeguard by putting those things in the contract. As advisors on the sell side, we really want to be making sure that we've thought of all of those things and if we can, corrected them in advance as part of that investor ready process and presented the information in a way that they're not going to find anything.
Absolutely. Absolutely. The other key takeaway here is making sure you've got really good legal advisors and that you have a good relationship with them. So you guys work well together. These guys, I don't think they did. And it sort of came to fruition in some of the terms that got accepted in the contract, and the way that they're able to push back against certain clauses, the way they're able to push back against things that were done in completion accounts. Not to say that anything untoward happened, but they weren't at the right sort of level. Yeah, so what else? So I mentioned a bit about the Project Vault, where there was that strategic reason for the vendor getting really high price. Really good story, that one. They were such a good vendor because they were also really ready to walk away if they didn't get what they thought they were worth. And the acquirer, they came to the party and paid them that. Yeah, Project WT is a current one that we're going with at the moment. It's a much smaller deal, but it's an interesting one because the vendor's relatively unsophisticated, so there's a bit of education that's going on, but there's also reluctance from them to provide information and make it a seamless sort of process. So we're finding it's hard to actually work with them. So our client sees it as being a really good strategic opportunity. They can increase the size of their business by bolting this on. They can get some synergies out of it. They've got a really good location, this other business, so they want to be operating out of there, but we're finding a lot of issues during the DD process. You know, an example we have today is around the creditor balances not tying up to the supplier statements. So yeah, there's things like that that are problematic. Yeah, so it goes again to that hygiene, but make it easier.
Yeah. One key takeaway I'll just throw in there, which might not be mentioned, is again, we're selling confidence in the future revenue streams, and a big part of that is having the key team locked in, and that might be with equity or incentive plans. Really important when a lot of times when acquirers are coming in and buying a business, that we do have that senior team locked in. So when we've got time as part of an investor ready process, that's one of the things we'll look at, is how do we lock in that senior team.
Yeah, absolutely. It's a really good point. That actually happened on the Project Ghost one. So one of the things that the acquirer actually did on that was to make sure the the key people were getting remunerated appropriately. And there'll often be cases where a transaction bonus is paid to key staff, and that'll typically be paid by the vendor. That's something that does come up quite a bit.
Yeah, to your earlier point about thinking about, well, what would private equity do? Well, private equity would want your key team locked in, because often they don't have the core expertise to run the business. They just want those people to stay in the business and not walk out the next day after they've acquired it.
And it helps if they've got skin in the game. We've got an equity position that they've had to pay for. That's really powerful.
Look, just Teddy, I'm mindful that it's 6:30, so we've hit time. Basically, we wanted to open up to any questions that might have come from the group during the discussion, or any questions that you might have.
I can see there's a question in the chat box about how many years of financial records should be required. If we're doing a valuation for valuation's sake, we'd probably look at 4 years historic, including current year, and then we'd have 1 year of future. When it comes to a transaction, there's a lot of ways to skin a cat in terms of coming up with the price. So yeah, it depends is often the answer, but you want to be able to see the trend. So if that's 4 years going back, and a couple of forecast periods, that could help you get some confidence in what the thing's worth and what it's actually capable of doing. You don't want to get to a point where you're buying a business where it's going up and down, and you're buying at the up bit, but you know it's going to go down next year. So that's obviously a killer.
Was there another question in the chat box?
Just about PowerPoint, I think. Which we can share. We're happy to do that. So,
I guess, sorry, it's Henry here. Just a bit of a questions. In terms of when you mentioned that the next 12-month estimations on the, I guess, projections, are you looking at a 12-month cash flow projections, I guess, as well as some sort of contracts or things like that? It depends on the nature of the business, obviously.
Yeah, absolutely. So when we look at forecasts, anyone can make a forecast that looks really good. It comes down to the assumptions that underlie it, and the more support that there is for those numbers, the better. So when we're looking at, as part of a DD process, when we're looking at a forecast or a forecast model, we want to understand the assumptions that they've used to build up the revenue streams. And then we want to go to that next level of understanding, are those revenue streams contracted, as you suggest, or are they just based on longer-term relationships? Are they based on us going out there, finding clients in the market? It depends on what the sort of business is, who their customers are. Like if they're a retail business,
there's not much contract on that end. Yeah, I was going to ask, follow on to that question. So let's say, in your experience or in your come across these situations, so if majority of the or the future revenues come from a handful of contract, for example, in your DD process, how do you require to disclose the detail of those contracts? Obviously, they're confidential in nature, just given that between the parties. But obviously, you try to sell it as a purchaser. Quite understandably, you want to look at the contract and make sure that the contracts are satisfied.
Yep. Yeah. So it's a fantastic point, and yeah. So I guess absolutely, we want to see that if we're on the buy side, we want to see those contracts. If you're the vendor, yeah, you're going to be wary about showing them that, especially if it's a supplier or a competitor that's buying you. Going to your customers, you don't want a supplier going direct to the market if the deal falls over. So you'd provide them on a redacted basis, but saying that, you'd probably want to supply them later on in the transaction process, so you've got a bit more certainty that the deal's going to go ahead.
I'll jump in there. That transaction we talked about before, the big one, that was in the defence sector, and it had a couple of really key contracts, without which the business wouldn't have had the same value, and they actually wanted to go and meet with them, and we held off, to your point, until later in the transaction. There were a number of hurdles we had to jump across until we were really comfortable that it was going to go ahead, all things being equal. And that we actually took them and they met with these key customers to get a level of comfort that this was going to go on. Because in my experience, contracts are often not worth the paper they're written on. You often have to go a step further to understand, meet these people where their key contracts.
Yeah, I mean, a common thing in contracts is how the transmission of ownership affects the contract, whether it's still going to be in play.
Yeah.
So that's something that the legal, whoever's doing the legal DD, they'll have a strong focus on that. So yeah, absolutely, they'll want to.
Thank you. Just got a question online. What's the typical multipliers in recent transaction for business in macro to SME in the space of $1 million? I would assume that's a turnover.
$1 million turnover. I'm not sure. I couldn't say in that space. I think when you're at that sort of scale of business, I think brokers are generally operate in that space, and they look at the sort of return to the owner as their way.
Sorry, it's actually $1 million in sale price. So let's say the business is up for sale for $1 million.
Yeah. Yeah, I mean, yeah, I don't know. If they're asking for $1 million as a price, you'd work backwards and see what their profitability is. If they're not profitable and they're asking for $1 million, they must have some sort of special source of IP that you're getting. I couldn't say.
Yeah, it's really variable in that size of transaction too.
Yeah, absolutely.
But certainly we want to see some. It'd be very much reliant on the level of risk in the particular industry around the revenue streams.
I guess I also got a question. Have you come across any in the fintech sectors? I know they appreciate it very hard to be put any multipliers on it. It's probably like multiplied by 200 instead of 500. Have you come across any example that you are involved with that has some ridiculous amount of money involved, perhaps?
As in ridiculous valuations.
Yeah, for example, we heard a lot of story where a lot of fintech company all of a sudden the value was dropped like 200 million instead of the 500,000 that they're probably worth. How do you guys actually value on those? Like let's say if you're on the buyer side, what it's gonna be quite interesting, isn't it?
It is like you're sort of describing unicorns if I'm reading between the lines. And sometimes these businesses, they don't have the revenue streams. I mean, and there might be another reason why they've got that high valuation. With a lot of those unicorns that came to prominence a little while ago, there were funds that were putting money in there on the expectation that the next round of funding would be higher, and therefore the value that they have put in at earlier would go up. So there could be other things going on in some of those tech multiples. The interesting, ridiculous one at the moment is that Donald Trump company that's made no money, loses money, and is worth a couple of billion or whatever. There's not really many fundamentals that would go to supporting that sort of value. When it comes to a social media platform, they tend to look at the number of users and apply a value to that. So
yeah, and sometimes, as you say, like when you do those methods, the asset acquisitions, let's say, or strategic acquisitions, when you then try to apply that value, it looks ridiculous in the context of a multiple, but it's not really relevant. I'll just add another point, that Chris's point earlier about, we saw a number of transactions coming out of COVID where it was a strategic acquisition to acquire staff. And a lot of consulting businesses were seeing sort of 10, 15 times multiple when you looked at their EBIT. And really that was based on a play to get key staff.
So it's not really tied to the revenue stream or anything. It's more like just try to get the people and then you pay.
But it's that classic point around value versus price. So a lot of the times when you look at the price compared to a multiple, it's out of whack. But if you look at the strategic opportunity of an acquirer in getting synergies or getting an asset that's going to then generate huge returns for them, it can often be out of whack.
Yeah, because they might be considering some sort of synergy they're getting for themselves. So with that, the earlier example about the distributor who got an amazing multiple because they're great at what they do, the value prop for the buyer was the buyer's got this massive portfolio of different products that are trading at this value or this price in the market. So they're selling a bottle of X, Y, and Z at this price. But if our client can get in there and help them get the price of their products up in the market, then it's got this outsized impact on their business. And that's that strategic reason why you pay overs for a smaller business that's not producing as much, but it's got that strategic influence.
There's a following up question from Justin. He was asking what industry types are currently seeing a greater amount of high value activity or transaction? And conversely, what industry type are proving more difficult to close off or complete transaction?
Yeah, okay. Look, I think I'd answer that with the comment that if you've got a good business, it's going to sell. And it's about finding the right acquirer. I guess one thing that we're seeing at the moment is there's a lot of interest from private equity to acquire things, but they've got to have that growth story. So it's not so much about the thematic of the industry. It's really the story that the business has and whether it's in the right sort of phase to grow. That sort of money, it's mandated to investment into X times return in X years. So they're looking at the growth and they've got a bit of dry powder. I'm not necessarily sure that there's a specific industry that's more in favor than others. It's or in our space at least, it's really about having a good business and looking for the right person to buy it.
Okay, so then there's one more question from Michael. If you are on a buy site to acquire a development management company with a pipeline of project, the project is quickly growing. What would your approach be to value the income stream?
Yeah, okay. I guess with that sort of business, I'd really want to understand whether there's sort of key person risk. So the smaller development companies that we've dealt with, there'll often be a bit of a figurehead who has all the contacts, knows who to tap to go and get investors and things like that, and to get the construction project off the ground.
Yeah, really close relationship with their contractors as well, with their subcontractors typically.
Yeah. So it's that personal goodwill question. That's what comes into play. It's an interesting one. So it's really about how secure is that revenue stream, and are they going to be able to keep generating those new projects to keep feeding that income stream,
Yeah, I think a lot of due diligence around the projects as well.
Yeah.
Because as we've seen in recent times with cost blowouts around developments, you'd really be concerned about whether the profit that they're saying in terms of what they're promising you is actually going to come to fruition. So you'd have to really be doing some thorough due diligence around the costs that are projected.
Yeah, absolutely. And the time frame they're going to achieve whatever sales they're going to get. Yeah, that's a good one. It's a good question.
Okay, so I think that will be our last question for tonight. Otherwise, we're going to be staying here until tomorrow morning. We're still going. So on behalf of CP Australia City Taxation Discussion Group, Henry, I would like to thank you, Chris and Matty, for your time, effort, and contribution to our group tonight. I'm sure if any one of you have any further question, the contact details on the screen, and you can contact them directly. I'm sure they'll be able to help you or your client further. So thank you all once again for attending tonight's session, and we hope to see you all back again in 2 weeks' time in CPA office. And until then, have a great and safe Anzac Day break tomorrow, and we'll hope to see you in 2 weeks' time. Thanks, everyone. Thanks, mate. Thanks, Chris and Matthew.
Thanks, everyone.